Hey everyone, welcome back to Corporate Dakota, the place where we take boring financial filings and make them, well, slightly less boring by looking at what actually matters. And no one's getting fired this time. This is Asana's latest quarterly report, and it's fascinating because it shows a company shifting in some big ways. Let's dive straight into the numbers. For the 3 months ending July 31st, Asana brought in $1969 million in revenue. That's up 10% from the same time last year. Not bad, but it's the operating expenses that tell a more interesting story this quarter. Research and development costs dropped significantly by about 13% compared to last year. This means Asana is spending less on building new stuff this quarter. Meanwhile, sales and marketing costs also dipped slightly by 2%. That sounds good for saving money, but remember, companies often cut back here when they're trying to control costs and maybe slow down growth. However, general and administrative expenses, which is basically overhead like HR and finance, increased by 11%. So while they're spending less on creating their product and selling it, the general running of the company is getting more expensive. That's a bit of a mixed signal on where their focus lies. All of this translated to a loss from operations of about $49.5 million for the quarter. That's significantly better than the $76.8 million loss they had last year, so they are losing less money, which is good. For the 6 months ending July 31st, the picture is similar. Revenue is up 9% to $384.2 million. Again, revenue is growing, but the expenses are eating into that growth. Their research and development costs are down 11%, and sales and marketing costs are down 3% compared to the first half of last year. Now let's talk about these non-GAAP numbers. Companies often use these to show a rosier picture by stripping out certain costs like stock-based pay. This quarter, Asana reported a non-GAAP income from operations of $14 million compared to a non-GAAP loss of nearly $16 million last year. That looks like a big jump, but remember, this is achieved by cutting down on research and development and sales costs. It's like saying you're healthier because you stopped eating and exercising. And then there's free cash flow. That's the cash left after paying for operations and things like equipment. For the first 6 months of 2020-25, Asana generated over $46 million in cash from operations. That's a huge jump from about $14 million last year. This is partly because they improved how they manage their working capital, for example, by collecting money from customers faster and managing their expenses better. What's also really interesting is that Asana is buying back its own stock. They spent over $43 million in the first 6 months of this year on these buybacks. This can be a sign that a company thinks its stock is undervalued, or they're trying to reduce the number of shares out there to boost the value of the remaining ones. Let's look at their dollar-based net retention rate. This metric tells you how much more or less existing customers are spending over time. Asana's rate was 96% as of July 2025. So for every $100 customers spent last year, they are spending $96 this year. This means they are losing a little bit of money from existing customers, which isn't ideal for their core customers, the ones spending more than $5,000 a year. The rate is also 96%. This is concerning because usually you want this number to be well over 100% to show that existing customers are spending more over time. Now let's quickly touch on the risks. Asana itself admits they have a limited operating history at their current scale, which makes predicting the future tricky. They're also in a very competitive market, and their reliance on AI features means they have to keep innovating. And they're very clear that past growth doesn't guarantee future growth. This is a standard disclaimer, but it's important they are really betting on AI and new features to drive growth. The ownership structure here is also notable. They have a dual-class stock system. This means some shares have more voting power than others. Effectively, a few key people hold most of the voting control. This is common for tech companies, but it means regular stockholders have less say in how the company is run. They also highlight the stock price volatility, which is something to keep an eye on. Now the big picture. Asana seems to be in a bit of a balancing act. They're growing revenue, which is positive, but they're also cutting back on R&D and sales expenses, which might be a sign of being cautious or trying to get to profitability faster. The fact that their net retention rate is slipping slightly among existing customers is a yellow flag. Usually you want to see existing customers spending more. The increase in overhead also needs watching. However, the jump in operating cash flow is a significant positive. It shows they are getting better at turning their sales into actual cash. Their gamble on AI could be a big big payoff if it truly drives new business and keeps customers engaged. But if their competition rolls out better AI features first, or if Asana's AI integration doesn't impress, they could fall behind. The company's direction feels like a push towards efficiency and maybe slower, more controlled growth rather than aggressive expansion. They're managing costs, but for now, profitability seems a ways off and they're still burning through cash overall. The stock buybacks hint at confidence, but the slightly lower retention rate among customers suggests they need to really excite their existing user base to keep growing. Alright, that's our deep dive into Asana's latest report. What do you think about their strategy of cutting R&D while trying to push AI? Let me know in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more straightforward analyses. Head over to our Discord community linked in the description to chat more about these filings and join the conversation. Thanks for watching and I'll see you in the next one.